4.5 years ago, Burgess and I started a public charter school in Redwood City. The first 2.5 years was really getting it together, funding it, finding the people, finding the teachers. That took about 2.5 years. And then this June will be 2 years in operation. We have about 240 kids at this public charter school. Its mission is to provide emotional based learning and project based learning, which is important because this is actually this is how kids learn. This is how people operate in the real world. They work through projects and they work and do well and thrive based on understanding other people's emotional states and their own emotional states, and yet it's not taught anywhere, at least not in public schools. So we started it and it's going well. The sad side is the Redwood City School District is now just blatantly lying about our school, telling people our teachers are not certified and we're going to be closing our doors at the end of the year, just straight out lying to parents in the town. And the reason they're doing it is because they're scared. They're scared because they lost. They have mismanaged this school district for decades. And we are in as a new charter school, and it is going really well. And two new other charter schools are coming in that are backed by billionaires. And so they're just absolutely scared. And they should be, and they should all be fired because they've done such a horrible job. But it's just so sad that they're just now blatantly lying about our school. It's the whole fight against, fighting against conventional thinking and conventional wisdom. And this is what kind of my big thing has been, going up against Wall Street and just their conventional ways of thinking and operating and managing money. And here it is again. We are not surprisingly, but going up against the conventional thoughts of public education, at least in this school district, is horrible. And so we'll be okay. Our kids will be okay. But the fact that the school district is cornered and now they're just blatantly lying to parents and other members of the community is just, it's so sad. It's so angering. And it just reminds me of how, you will do whatever conventional thinkers will do whatever they need to do to protect themselves and protect their payment, their monthly check. And I don't blame humans for acting that way. The problem is the collateral damage in this case is students getting horrible, horrible educations. In the case of Wall Street, the collateral damage is people having a much lower return on their investments over their lifetime, which means lower security and lower freedom. So, eliminating conventional thinking from the world and the collateral damage because of that is really a big part of what I'm about, and one of the reasons why I moved to Silicon Valley, because Silicon Valley is really nothing more than a place that creates businesses and ideas that crush conventional thinking and conventional wisdom. I mean, how else do you get one of the most successful car companies in the last half century started building cars right here in Silicon Valley? That's Tesla. I mean, it's pretty amazing. But we don't live, we live in a relative world. We know when we look at other worlds, we can compare other worlds, other countries. We can't go to Mars, we can't go to Venus and get help from over there or invest over there. And so I want to talk with you about this whole idea of relativity. Hey everybody, this is RC Peck, and this is my weekend podcast. I'm sorry guys, I was really, really sick yesterday. I had like a 24-hour, oh my God, stay horizontal, don't get up, flu or something, and I'm over it now, but there's still some lingeringness of it in my brain and my body. The theme of this weekend is sometimes relativity is everything, right? We live on planet Earth. We can only invest on planet Earth. Within that, we can only invest in companies, currencies, debt, and physical assets. That's it. We only have 4 places we can invest our money on this planet. So sometimes relativity really is everything. Now, in this case, or this point of relativity, I'm going to talk about something really sexy and exciting called interest rates. Well, right here in the US, the 10-year yield, or the yield on the 10-year Treasury, is right about 2%. And the price chart you're looking at goes back to the beginning of 2008. So you have 1, 2, 3, 4, 5, 6, 7, a little over 7 years of data showing you what the yield is on the 10-year Treasury. Back in 2008, the yield on the 10-year Treasury was about 4%. Today, 7 years later, it's 2%. The lower the yield goes, the more someone can afford, or the bigger price or the bigger house, the more expensive house someone can afford, because what they're really looking at is what they can afford in monthly payments. So here we are, interest rates at 2% on the 10-year Treasury. Now this doesn't really mean much in a vacuum, but if we go look at what's happening in Germany, hold on a second, what's happening in Germany, the yield at the beginning of 2008 was 4%. So US 10-year yield, 4%. German 10-year yield back in 2008 was 4%. Well, today, if you look at the price chart, you can see this visually. The yield in Germany for their 10-year bond equivalent is 0.19%. You got that? It's not even 0.2%. It's less than 10x. It's 10x smaller than in the US. So Germany will give you 19 basis points, or 1/20th of a percent, if you give them your money for 10 years. This is incredible. This is absolutely deflationary. And this makes sense because Germany is afraid of inflation. Germany is absolutely afraid of inflation and hyperinflation, so it would make sense that they overcorrect to a deflationary type position. And this is what's happening. This is pretty amazing. I mean, just in 2014, the yield on the 10-year in Germany has gone from basically 1.75% to 0.19%, almost 10x less. It's pretty amazing. Now, as you can see on the next chart, generally speaking, German bonds 10-year and US bonds 10-year have pretty much kind of moved together. The most, or the biggest gap you'd ever see between them is about a 25% difference, meaning if the 10-year yield was at 1%, the German yield would be at 0.75% or 1.25%, meaning there'd never be more than a 25% difference between the two. But now today there's almost a 90% difference between the two of them. I mean, this is pretty amazing. I mean, the percentage points between them, you have 2% in the US and you have, let's just round it up to 0.2. That means there's 180 basis points, or 1/8% between them. So here's my point, or at least one of the points I want to make. The probability of the 10-year Treasury going much, much, much lower, even lower than it was in June of 2012, I think we have an 8 out of 10 chance that we're going to see the 10-year Treasury below that low in June of 2012, which was about 1.37% yield. And the reason I say this is because if one of the next major bond markets in the world is paying something that is significantly lower, that means people around the world are going to want to put their money in the US 10-year Treasury. And that's going to make the price go higher. And when the price goes higher in a bond, the yield goes lower. And that's what's going on right now. Now, what does that mean to your portfolio? What does that mean to actions and behaviors you should have going forward? Well, I'll give you that in the takeaway, but this is pretty phenomenal. If you look at the gap between the yield on the German 10-year and the yield on the US 10-year, that's pretty phenomenal. These two yields pretty much stayed in lockstep until now, and it is a much, much bigger difference that is happening. And that's why I think the yield on the 10-year US Treasury is going to get pulled down much, much lower. And it's very likely we'll see the yield on the German 10-year go negative. A 10-year Treasury, now the 5-year Treasury and the 2-year Treasury in Germany is already negative. But the 10-year to go negative, this is going to have more money flow into the bond market in the US, which will drive yields down. So, what is the takeaway? Rates are going lower. Even if Miss Janet Yellen increases the federal funds rate, that is just super short term rate. The long term rate of the 10-year and the 30-year Treasury, the market determines what those rates are. We could see short term interest rates like the federal funds rate go higher, and the 10-year and the 20 and 30-year go lower. And in fact, that's what we're going to see. I think we have an 8 out of 10 chance, maybe even a 9 out of 10 chance of seeing that. Rates are going lower, and that means it's refi time. It's time to start getting your numbers together, start preparing yourself emotionally that you're going to want to refi your house. If your house is paid off, I think you should take money out of it. At least here in Silicon Valley, you can refi and adjust it for taxes. It's about 2% of what you're actually paying to get that money, and inflation in Silicon Valley here is about 5%. So it's totally worth it. It also means real estate is still a good investment. Stocks are still a good investment. And it also means we will probably see deflation first. Now, this whole deflation first thing is, I'm saying this specifically because I think ultimately we will have inflation after this deflation is done, because the governments of the world, the big governments of the world, they will just keeping their monetary policy very loose and very easy and lots of money printing until they see inflation. And history says they have not been able to stop the inflation once it starts. Hey everybody, this is just another step in helping you secure your portfolio and your future. Until next time, this is RC Peck.